I think that may be the reason that gold is hanging in there. I think the reason that gold hasn't soared, frankly, is that we were schooled by 40 years of benign economic climate, beginning in 1982, and I would suggest ending in 2022. So I think that confidence is quite high. While I'm attracted to the performance of the broad economy, I am not attracted, but rather terrified when I look at collective, which is to say government balance sheets. We've talked about this. The strength of the U.S. economy has not translated into covering the budget deficit, as an example, or dealing with the debt. And that circumstance is the same in Europe. I think that increasing nominal interest rates has made short-term deposits more attractive. And I think that that has detracted from acceptance of precious metals. But I think a much more important reason is that because all of us were schooled in terms of our investment performance and expectation by 40 years of benign economic climate, which is to say we've been schooled not to become scared. I may be excessively scared, but when I look at gold and I think about the fact that, as you say, it's, quote, held up, I am really surprised that it hasn't gone further faster. When you talk, as an example, about real interest rates, understand that I would define a real interest rate as a rate paid as rent on savings that exceeded the depreciation of the currency that the savings were denominated in. And the forward-thinking measures of inflation, I think, are very misleading. As an example, when it suits them, they describe core inflation, which doesn't include food or fuel. As your listeners can tell by looking at me, I like to eat. And so that definition of inflation doesn't apply to me. But two, when they talk about CPI, Consumer Price Index rate of inflation, they're really trying to construct a cost of living index. And the fact that inflation doesn't include the cost of government, which is to say tax, which consumes more household income on average than food, energy, shelter, and travel combined, you truly have a fallacious index. And I guess that one of the things that has, I think, kept down the gold price is that consumers and investors and taxpayers have come to allow their interpretation of inflation, to be shaped by what is frankly a fraudulent method. When I look at the impact of increased taxation and the certain threat of more rapidly increasing tax on my budget, I understand that the stated measure of CPI has in no way measures my own cost of living. If I didn't have to pay the tax, I probably wouldn't complain so much about the index. But I suspect that very much like in the 1970s, as people come to understand the impact of the deterioration of the purchasing power of their savings, that people will become less wedded to interest-yielding savings products and more interested in investments that traditionally have offered better shelter from inflation. You have to measure how it's measured. Their 2% number works as long as people believe their inflation measurement matrix, which is itself fraudulent. When people focus on that number 2%, they need to focus on the measure of constructing that index and how that impacts their cost of living. Imagine that you're a Dane and that 58% of your household income is consumed by government, yet your government continues to run a deficit. Imagine now that your savings in euro-denominated bonds are yielding you 2% in euro, where the after-tax purchasing power of your savings is declining by 6.5% compounded. What you learn as a Dane is that your savings are costing you 4.5% of purchasing power a year, and you're ignoring the largest single factor in the depreciation of your purchasing power, which is to say increased taxation. I'm not saying this merely as a political statement. I do like to propagandize. I'm saying this because people pay attention to easy to grasp headline statistics like a 2% inflation target. The problem with a 2% inflation target is that the measurement matrix that people are accepting is fraudulent. I see a huge chance of that happening. And I think that the policy response to a deflationary shock would be quantitative easing and government borrowing, which is to say, ironically, the policy response to deflation would be extremely inflationary. Again, we saw that in the mid-1970s. In the mid-1970s, we decided to raise interest rates further to combat inflation. That resolve lasted a sum total of 9 months, if my memory serves me well, before the political powers and, frankly, the voters decided to return to a policy of free beer and a free lunch, which couldn't last. I guess I have a different orientation and a different time frame. I don't own gold for a move from 1950 to 2075. I own gold to preserve my wealth. And your listeners are going to hate this because they're young and aggressive and all these kind of things. And they're trying to make their car payments and stuff like that. I own a lot of gold, and I kind of hope the price doesn't go up. For me, precious metals are catastrophe insurance. And I just as soon not have a catastrophe. I hope when I shed my mortal coil, however old I am, that I look back and say, owning all that gold was a waste. But it allows me to sleep nights and stay calm. I guess as a consequence of that orientation, I'm much less time sensitive. I own gold and silver, and I own most equities with a 5-year term or a 10-year term. It's odd now that I'm 70 years of age and I have less time on earth that I've become much more patient. When I was 21 or 22, I sort of thought that what happened over the next 2 or 3 months was relevant. But it's so impossible to forecast, and the moves that you can enjoy in 2 or 3 months are so small that they really aren't relevant. 5-year timeframes, 6-year timeframes, 10-year timeframes are very relevant. And we've discussed this before,